Welcome to TMS Insights. It's August, that means that's reporting season. Very busy time for us. A lot of company reports, a lot to get across and a lot to let you know about. So it all started last week, Ben. Some of the numbers coming out, really good news that we found with the early reports.
Yeah, generally I think there's been a lot of pretty decent share price reactions. It's been interesting. Firstly, I think some of the blue chip stocks where we've seen very little share price movement for some years now, seems like they're starting to get a bit of a move on, and also some of the the much poorer performing businesses of late, sort of over the last 3 to 5 years, even on fairly disappointing news, have actually seen positive share price movement.
Yeah.
So might sort of indicate that fairly low expectations in that end of the market, and that'll be what drives our market if it can continue to occur.
So obviously expectations are important. We know that analysts set numbers they want hit. If they don't get hit, we see price volatility and downside. Just talking about this price action for a bit, because there's a fair bit that happens on the day of a result. Typically they come out before market, there's an initial reaction, It can be quite severe, can turn around. And even today when we get to talk about today's stocks, we saw stocks down 11 or 5% that halved that within a couple of hours.
Yes.
As market got its feet again and brought back up those stocks.
Yeah, and one of them came in bang in the line of expectations, and one was just a tiny touch under. And I think you're right, Jeremy. Firstly, I think it's important to strip out that a company can still have a great result and see a share price sell-off.
Yeah.
And that might just be that the analysts expected an even better result.
Yeah.
So Cochlear was an example today that came bang in the middle of its guidance range, earnings guidance for next year, bang in the middle of the guidance range, but there were some analysts that were quite a bit higher than that, and they would have seen this as a disappointing set of numbers. So it's all in the eyes kind of the beholder. The other thing I'd probably say is try and avoid worrying too much about short-term share price reactions. There are so many things that happen on the back of results that are unrelated to the next 5 years of that company. And I think particularly these days, short selling and hedge funds, and there's a lot of weird things that happen around reporting.
And it's also the nature of accounts themselves. I mean, a net profit statement can include things that don't really tell the story of an underlying company investing in the long term. And let's get to Cochlear, because that's a good example, Ben. Again, a good set of numbers, you could not be unhappy with that, and then very good guidance numbers for growth coming in the 19 year.
Yeah, good numbers. I guess the point I make probably here is the numbers could be a lot better. But what this business is doing, and there's a number of other of our companies that do something similar, is that they're reinvesting their capital back into the business. And as long as the business has a good track record of getting a return on that capital, and also is in a growth sort of area of the market where they're not trying to grow their way out of a problem, that's a good thing. And Cochlear would be generating much stronger than 10% profit growth if it was letting more of that revenue drop to its bottom line. But instead it's grabbing that and it's pumping it into other areas, or the area of its business where it sees attractive returns. So the profit numbers can be misleading, and that's why revenue numbers can often be a better thing to have a look at.
Okay, so good one there. One other one today we followed quite heavily is Challenger. It was a good set of numbers, a small miss to consensus, an initial negative share price reaction, Ben, but there's a good longer term story, particularly in their annuities business.
Definitely. So, they missed their expectations by market expectations by 4%, which is a pretty narrow miss, but they have guided for a year ahead that was stronger than the market was expecting. So if they can get towards the upper end of that range, we'll actually see upgrades come through over the next 12 months. But I still don't think you can go past the next 10 years with this business. There's currently $800 billion of super assets in drawdown or retirement phase. And annuities make up about 3.5% to 4% of that capital that's invested. And Brian Benari on the call was saying in 10 years, there'll be $2.1 trillion that is in drawdown phase, and Treasury and the government are trying to significantly raise that 3.5% because they want people not to lose their retirement assets to fall back on a government pension. So you take a longer term view, Challenger is in the box seat to take advantage of those thematics.
Yeah, good one. Last week, REA reported on Friday, obviously one of our favourites. Good numbers, interesting listings in July a little lower. We also heard from Domain on Monday, which told us a similar story.
Yep.
So that's clearly a thematic in the industry. Both are terrific stocks, Ben. How did you make up between the two of these?
Yeah, look, I think REA's was the superior result, but Domain was messy because it's been split out from Fairfax and they're still trying to find their own cost base and feet and all those sort of things. I think both were good results. REA's was, I think, particularly pleasing given we did see a drop-off in listings through the second half of the year, but to grow your profit 23% during a time like that, the business almost feels bulletproof. I mean, you shouldn't say that, but even in a softer housing market, there's reasons to like REA, and that's because people will use generally more expensive ads, and properties also take longer to sell, and there's less off-market sales of properties. So these all benefit the REA model, and they push through a price increase in the 1st of July, which means this year everyone's going to be paying higher prices. So still a great business. I think Domain is going better though.
Well, it's improving, and again, there's big issues going on there. We'll get to, but the main thing is don't correlate property prices with the performance of these portals. They're
absolutely
much bigger than that.
Yep.
Now, the big deal going on with Domain is that Fairfax is in the process of receiving a bid that will mean that Fairfax's full ownership will go to 9, a script-based bid that is really all about acquiring that large stake in Domain.
Yeah, and look, I think we spoke about this stock probably about a year ago now on the TMS views, and it's been a great performer since then with the split out of the Domain business. I think we actually said at the time when they were getting rid of the media ownership rules, it was inevitable to us that something like this was going to happen.
Yeah.
The deal makes a lot of sense, I think, to everyone. You'll probably see the block cross-promoting Domain. And when you think more and more about it, the opportunities are endless in cross-promotion, taking cost out of both of the businesses. But it's Domain that Nine's interested in,
Definitely,
right?
No question. So that was a very big one. ResMed reported, they were good numbers. Gee, what a consistent business. And again, potentially got valuation upside. It's not a cheap multiple, but if it was put against peers as not a device manufacturer, but a SaaS style of business, we could see some PE expansion here, Ben.
Yeah, I think so. This is, you love it when a CEO says, despite what we've achieved, we think we're on the start of the next decade of growth for this business. And actually, Mick said the next 10 years to us actually looks better than the last 10 years. And that's because there's still a huge number of people that need to be treated with sleep apnea, but also the launch of this service as a software business, this IT business, where they're now effectively bringing people onto an ecosystem that can record and monitor their sleep, and doctors can monitor that through the cloud. And this is probably like a great example of a healthcare company transforming itself into almost a technology stock. Still think a great future for ResMed.
Another great business, Ben, and in reporting, Seek hasn't yet reported, but it gave an update a little over a week ago. And this is a company we do understand very well. We understand how it operates around the announcements it makes publicly. So effectively, a downgrade to the earnings expectations, a flat year ahead, more investment in the business. Price reaction, which was negative, Ben, initially. It's found its feet a bit. And again, sell-offs in this company have always been an opportunity.
It never ceases to amaze me that people keep selling it when these announcements come out, because it makes no sense. Again, Seek sees great things to do with its capital, and it's not spitting it down to the profit line, it's reinvesting into its early stage ventures. You look at the headline, the top line numbers, 16 to 20% revenue growth for a business that is now this big is significant. There were some small non-cash impairments of a couple of its online businesses, but it's kind of like a loaded spring, It's they keep investing. At some stage, that profit will start to work its way through.
A wave of cash will hit through. It might be years yet.
It might be years yet.
They're thinking years ahead, which we want businesses to do.
Definitely.
Now, banks. Commonwealth Bank reported its full year profit. That was last week. We today had the quarterly from NAB. The bank sector generally, we've got obvious pressures on earnings, and the credit environment is slowing definitely, Ben. Commonwealth Bank in good shape, did have a small increase in the dividend, but the earnings outlook remains pretty underwhelming.
It does. Look, I'm sort of in two minds on the banks at the moment. I think it's amazing how well the earnings have held up despite all the stuff that's going on for the last 12 months. I mean, NAB's just reported earnings down 1%, cash earnings, and CBA was down 3 or 4. So that's pretty incredible, and it goes to show how good these businesses really are. But when you do look at the analyst outlooks, across all 3 or 4 of the banks, the analysts are forecasting no earnings growth for the next 4 to 5 years. Yeah. So I think it's going to be much of a case of the last couple of years, Jeremy, where the banks are going to go through periods where they're in favour, the share price is a bit stronger, and they're out of favour and they're a bit weaker. A
bit of range trading for the share price. Yeah.
But paying great dividends.
Great dividends, yeah. So if you want yield, it's a good place still, and they are in good capital positions, which is more than we could have said a year or two ago. So that's
definitely
certainly good. Well, that's all we've got in today's video. We'll bring you another update and then a wrap up at the end of reporting season, but we've got to get back to work now.